Wynand, all good on your side, buddy?
Yes, everything is well. Some of the delegates might remember the last time I visited you guys. My baby was still in hospital, and she's now doing very well. When we came on, I showed Faisal the baby, and so I say, yeah, no, it's nice, and as long as she's healthy, I find that we are happy. There's not a lot more we can wish for at the moment. So yeah, all good
Yes,
on us. And thank you for asking.
excellent. Thank you. Okay, we're on to 300 delegates, and the delegates are quickly trickling in. So, guys, welcome. Colleagues, welcome. For those of you live on Zoom, and of course, those of you guys live on YouTube, we've got an exciting topic today. This is the first of our 2021 PPS webinars with Mr. Wynand Du Preez and Mr. Yazeed Davids. The topic for today is tax updates on the budget and what to do now with your investments. So these are two specialists from PPS, so we're looking forward to their insight. Before we get started, just some quick housekeeping rules. For delegates that are on the Zoom, please refrain from using the raised hand, but rather type your comments and questions in the Q&A tab at the bottom of your screen. The CPD certificate for this evening's webinar will be loaded on your SADA platform, and you'll be able to access all your webinars, this one, the previous ones, and future ones under your member profile. If you're not a SADA member, you'll still be able to create a profile for yourself and access your CPD certificate. This evening, you qualify for one clinical CEU. We're also live streaming on YouTube just in case any of the delegates on Zoom have difficulty connecting or you get kicked off in the middle of the session. You can always follow us on YouTube. And a gentle reminder at the end of the webinar to please complete the evaluation form. Also, the upcoming events, I mean, as you know, with the whole COVID situation, SADA has been very active with their webinars, some very exciting webinars. We've been getting some huge turnouts and some awesome feedback. So I know you guys appreciate what SADA is doing, and I mean, we're looking forward to hosting more and more webinars going forward. But just the upcoming webinars, the Pedodontic Society is bringing 4 international speakers to the podium in this month of March, and this is to celebrate World Oral Health Day. So look out for the PSSA webinars on the 9th of March, which is tomorrow, the 16th, the 23rd, and the 30th of March. Those are the 4 webinars for the month of March hosted by the PED Society in collaboration with SADA. Also on the 18th of March, a very exciting second webinar in the Dentistry's Great Awakening series. The title of the webinar is Noses Are for Breathing, Mouths Are for Eating. And that'll be hosted by Mr. Patrick McEwen, who will be coming to us live from Ireland. And then on the 25th of March, Dr. Antoinette Merrick from the South African Depression and Anxiety Group will speak on resilience and depression. So we've got an awesome lineup for the month of March. So if you guys can just take a note of that and save those dates accordingly. Okay, so without further ado, let me introduce our first speaker, Mr. Yazeed Davids. As he said, it's his debut webinar with SADA, but he's full of enthusiasm and he's a tax specialist. And obviously the topic for today is on the tax update. So we're looking forward to his insight from a tax point of view. Yazeed, the floor is yours.
Thank you so much, Faisal. Thank you for having me. It's a privilege to be here tonight. I'm hoping that what I share tonight resonates with everyone in the room, and then the importance of tax and financial planning for the next 12 months or so. Our country's gone through a pandemic. It affected us financially. We had a budget speech. So I'll just highlight the advantages and disadvantages and the pros and cons there too. So before I start, the minister was very cynical in terms of his speech. Exactly 7 days ago, we said, and I quote, "We owe a lot of people a lot of money." And that was a blunt statement. It was an ominous statement by our finance minister in his budget speech. It showcased and it shows how deep a financial hole South African economy is at the present moment. There's the actions happening in the market, and hopefully, this is the road to recovery. There is warning lights flickering as well. the much talked about wealth tax, or how this would work. So let's go into the budget and a few highlights in terms of the budget speech that was done by our Minister of Finance. Okay, key highlights to the budget. Just off the backdrop, the Minister quite carefully crafted a statement saying that the budget has a financial framework that supports the economy, the public health service in the short term, as well as sustaining the public finances. So there's already three topics that was paramount to and important to the budget speech. One of it, obviously, how do we support this ailing economy that we're in, and how do we support the health sector in terms of distributing the COVID-19 vaccines, and obviously trying to reduce costs within our public sectors. Like our Archbishop Desmond Tutu says, hope is able to see that there is light despite all of these darkness. So South Africa is going through a very dark time at the moment, but there is hope. There is light at the end of the tunnel. Positives out of the budget. In terms of the tax measures that was proposed in October, there was no mention in the budget this year that the measures put in place in October or proposed in October will take place. This speaks to the wealth tax that was proposed in the midterm budget in October. The next positive, government's allocation of spend in terms of the rollout of the COVID-19 vaccines. Whilst I was putting this together, I wasn't sure whether or not it was a positive or a concern, because whilst purchasing this vaccine, we're up against the first world countries. In terms of exchange rate, do we have enough buying power to secure those, the vaccines? The president in his previous State of the Nation address, he mentioned that herd immunity is around about 60 to 66% of the South African population, whether 10 billion rand is sufficient in securing herd immunity, only time will tell. The next positive, and this I think speaks to government's plan to really fast track the vaccine process, is by putting additional 7 billion rand aside for further vaccines and contingency or emergency plans in trying to get to that herd immunity status that the country so desperately need at this moment in time. Another good positive that came out of the budget is that in terms of the tax relief, the expansion of the tax bracket has increased by 5%. Typically what this means is that from March 2021, the disposable income, one would see an increase in your disposable income in terms of widening the tax bracket. The value to that tax relief is in the region of 2.2 billion rand. And the minister jokingly said that the tax relief is above inflation rate. Another nice tax relief that came out of the budget, or positive that came out of the budget, was the corporate tax. The corporate tax, however, for this tax year will remain at 28%. And as from the 1st April 2022, that corporate rate now drops to 27%. A nice indicator and an invite to those foreign investors to come into South Africa to set up shop and try and establish a medium in doing business in South Africa. Another positive that came out of the budget was the allocation of a 1 billion rand spent on our Department of Justice and the constitutional development in terms of the business processes and how we're trying to provide and plan for those SMEs. In terms of the concerns, this has all commentators speaking that the tax deficit is expected to be around about 2.13 billion rand. So South Africa is expected to undercollect in tax of 2.3 billion rand. That number is growing year on year. What does that mean in terms of the budget deficit? It is exactly 12% of our GDP, which is a huge, huge amount in terms of the deficit in tax collection. The gross debt is ever increasing. It is sitting at levels around about 65.6% and is expected to increase to a rate at 80%, just over 80% of GDP. Government's stabilizing forecast at 88.9% of GDP in years 2025-26. That further hones the debt that South Africa currently finds himself in and the provisions of what the increase in that debt and in the debt amount would be over the next few years or so. A cost allocation in terms of servicing debt, it is average at 20.9% in debt servicing cost. So basically what that means is if you were forecasting and you were forecasting a business, there is a debt service cost expense item on the cash flow statement around about 20.9%. That is a big number to service debt only. The expected gross revenue over the next 12 months is 2.697 billion rand and 338.6 billion rand in 2023-24 calendar year. In terms of the gross loans are expected to increase from 3.9 trillion rand to 5 trillion rand in 2023-2024 year. That, by the way, equates to 11 zeros of the 5.2 and 11 zeros thereafter in terms of gross loan debt. Government's intent and will. Key highlights that came out of the budget. There's a strong support in reviving the economy in the short-term period. Undertake to reform, lower or cost in terms of doing business in South Africa and stabilizing the public finances. The stabilizing public finances has caused a major outcry in the public sector, where the minister has indicated that all public servant increases will be put on hold for the time being. There has been the government's will to stabilizing the consumption or the supply in electricity. So that speaks to the will and desire to make Excom a successful state-owned enterprise and to get it out of its dilemma it's find itself, to support the industry with employment potential, and this speaks to helping SMEs, and then obviously partnering up with the private sector to help stimulate and re-energize our economy at the moment. These talks are finalized the public procurement bill, so that's what happened in the short to mid-term period, and then the framework from a zero-based budgeting across all government department and sector. This is all in the help of reviving our economy at the moment. In terms of the SARS expansion program, about 3 billion rand has been allocated to enabling SARS to deepening the technology and data for machine learning capabilities. This will help in auditing processes And I think this speaks to the framework of introducing the new wealth tax. To date, there has been no indication of that, how the framework will happen. There is no legislation to that, but that is all in preparation for the much anticipated wealth tax. Expansion on specialized audits and investigating skills, the abuse of transfer pricing to an already eroded tax base. Tax crime has been on the increase in terms of direct and indirect taxes. And establish dedicated unit to improve compliance of individuals with wealth and complex financial arrangements. So there is certainly indication the seriousness in terms of trying to lesser the tax burden collection gap. In terms of the spending, the key highlights in terms of spending, government over the next year to medium term will spend in excess of 2 trillion rand. The bulk of that spending will be to the learning and culture sector, and that's obviously towards education, to school fees and university. The amount is in the region of 402.9 billion rand. In terms of social development, and here this speaks to the social grants and obviously taking care of the less fortunate and disadvantaged people in terms of the rural communities, wherever they find themselves in South Africa, and obviously in our health sector as well, in aiding to try and roll out the COVID-19 vaccine. They spent in terms of our economy, that's 5% of the 2 trillion rand will be spent on the economic development, trying to revive our economy, as well as community upliftment and development, especially in our rural communities, and then the general public service sector. Another spend is towards our state-owned enterprises, things like Eskom and SAA comes to mind here. Looks like government will try and allocate more monies to those SOEs. In terms of tax revenues for 2021-2022 season, 38% of our tax collections will come from individuals. That equates to 9.7% of our GDP. 27.1 in terms of indirect taxes and VAT, at 15.9% of our GDP, and then 15.6% in terms of corporate taxes. Since the financial crisis, or the beginning of financial crisis in 2008, the individual contribution to the three main taxes has changed drastically. And so the main contributor to tax collection, unfortunately, will be coming from personal taxes, and that will aid in terms of when government introduced the new wealth tax as well. Tax compliance and proper professional planning in terms of financial and tax planning is now become more important to make use of any benefits, tax benefit allowances that exist. It is key to navigate any aggressive or tax reforms or legislation that's going to happen in 12 months or so. So encouragement to make use of a good financial and tax planning professional. In terms of selected themes, fuel has been on an increase since the budget announcement. We've seen fuel raised to 15 cents per litre. The RAF levies 11 cents per litre, and then the carbon increased to 1% per litre. Sin taxes on the increase as well. Alcohol and tobacco, 8% up increase, 40% on your beers and ciders, 27% in terms of wine, and 86 cents on your sparkling wine. 550 in terms of spirits, and cigarettes up on 139 per packet of 20. 47 cents in terms of tobacco, and then 7.71 rand in terms of cigar. So Faisal, as mentioned before, Financially, South Africa is in a deep hole. We sitting at the back end of a COVID pandemic. There's key things in terms of rollout of the vaccines, and at the same time, we're trying to juggle an economy and trying to revive that, so that we can, shorten shorten the tax deficit that is expected out of the budget. So that is all from a tax side of things. Over to you, Faisal.
Yazeed, thanks for that. After seeing your numbers, my palms are sweating and my heart is palpitating. So I always believe that in adversity comes opportunity, but we need to be realistic here. Do we have a problem?
Yeah, thanks for that question, Faisal. Remember that the budget, it's not an economic policy reform exercise. It's an allocation of monies and where it's going to be spent. Yes, we are in trouble. We're a debt-laden country, but there is hope that with a revived economy, South Africa will be in a better state in the next 5 years or so. But currently, as things stand at the moment, we are in very troubled waters at the moment.
I mean, just when I hear about 11 zeros after the 5.2, that's enough to give anyone a heart attack, eh?
Yeah. So that is the levels of our financial crisis that we're experiencing at the moment. And what we need to understand as well, we're up against the global economy. We trade with the global community. We rely on the global community to help us in time, especially with the vaccines. Imagine South Africa competing with a country, for example, as America. Just the currency there's a big difference in terms of currency rates. So when you go to a pharmaceutical company and you want to buy these vaccines, you have to part up with the rest of the African countries to have a chance in securing those vaccines at the rate at which your first world country would get it at. So yes, South Africa financially is staring at a dark tunnel, but I'm sure with proper leadership and people with good plans and vision in place, we can get out of this dark tunnel. And yes, I believe that we have the resources to do it. We just need the right leadership and good imaginative ideas in trying to get out of this in this financial crisis that we're in at the moment.
Okay, so this webinar is structured with two speakers. The one is on tax, which Yazeed just presented, and the second part is on investments, which Wynand is going to present. Yazeed, we've got 4 questions, and normally we leave the questions for the end. But if Wynand indulges us, then we can go through the 4 questions that deals with what you've just spoken about. We've got about 7 minutes, and we're kind of on track with time. Wynand, are you okay with that, Butch?
I will address, I've seen some of the questions come through, and part of what I will deal with will address some of that. So if I can make a suggestion, and I'm comfortable either which way, if I can make a suggestion, maybe let's go through my content, and then we've got ample time at the end to deal with these questions. I think some of that might be addressed, not everything. I've seen some excellent questions coming through there. But yeah, I think some of that will also tie into my content. So maybe let's do everything at the end.
Okay, wonderful. Let's do that. Okay, so Wynand, that brings us to your section of the webinar. Wynand is no stranger to the PPS SADA webinars. He's done a wonderful webinar late last year with some awesome reviews. Wynand is the regional manager of Inland. He's a specialist support services in the Inland area where he oversees a team of 5 technical specialists. His key focus areas is on risk planning, investment and retirement planning, business planning, and holistic financial planning. And his key focus is on high net worth clients. So seeing that dentists are generally high net worth clients, right? Not with 11 zeros, I doubt 11 zeros after our bank, after our wealth. But I guess, I mean, we need the specialist. We need your speciality to guide us. So Wynand, the floor is yours, bud.
Thank you, Faisal, and thank you for the opportunity. I'm always scared once you've done one webinar that people can say, "Oh, please don't ask that person back." So your first webinar is always for me an interesting one, but it's always a very humbling experience if they ask you to come back. So thank you so much to Sada again for giving PPS the opportunity to speak and for inviting me to also be part of this webinar. We got a lot of questions the last time around about investments, and I thought it well to now, after the budget, say, okay, what is it that we should be doing with our investment? Now, what I'm going to do is I'm going to speak a little bit before I get to investments. I'm going to speak a little bit about the current market conditions and the different asset classes. I will also to try and give you some guidance on what to do now with your investments. And as part of that conversation, we will touch on diversification a little bit, because I find that everybody doesn't really understand the concept of diversification. And even in the cases where they do, sometimes people think they are well diversified and then they are not. So if you will allow me, I will take an opportunity just to talk through that a little bit. All right. So what is currently happening in the market now? I just want to say off the cuff, you might find some of the things that I say and share with you really boring. I find it interesting. I just finished up my dissertation for my master's degree in finance, and I wrote it about government and government debt. So all of these things are quite interesting to me. So if you find it boring, I really apologize. I hope the investment part will be exciting to you. But I think it's important for those of you who are interested in macroeconomics and in investments to just understand what's going on in the world at the moment. Because I think one of the big challenges is there's so much noise around. There's so much things that we hear. And it's difficult to kind of see what is real, what is not, what is actually currently happening in the world. Right. And Yazeed, maybe you can just mute your mic. I'm hearing some noise there from your side. So just mute that for me if you don't mind. Thank you so much. All right. So from our budget, the following expected growth rates came out as we see growth happening in the rest of the world. So globally, we think that the GDP, which is your main measurement of growth, will grow by around about 5.5% for this year, and then 4.2% in 2022. So tapering off a little bit. China coming in with healthy growth at 8.1%, and we have now seen some of the data that came out over the weekend that shows that China actually recorded better than expected exports. Now, there's two things that's important there. One, that is good for China because exports is their main thing that they do. They became the world's second biggest economy by becoming the world's biggest exporters by far. So that is a very good thing for China's economy, and that number might even tick up. And it's also very good for global trade because, I mean, it shows that China is selling things, they're producing things that they're making, and other people is actually buying it. So there's definitely an uptick in global growth. Then in India, we see there could potentially be a double-digit growth of 11.5% for this year, which is very, very healthy. And then almost a bit of a disappointing 3.2% for sub-Saharan Africa. The reason I say it's a little bit disappointing is because in our lifetime, once China and India kind of stabilizes, there's a lot of consensus that the biggest growth in our lifetime will happen in sub-Saharan Africa. And just to touch on the question of what you guys asked earlier, if South Africa will be able to recover or not, a lot of that will depend on whether we can get our house in order and piggyback off a lot of the growth that will happen in Africa. For instance, there will in our lifetime likely not be a continent where more growth in insurance happens than on the African continent because of our young population, because of the growing middle class, a lot of things that we can say about that. And that's why I'm saying sub-Saharan Africa, a little bit disappointing at 3.2%, but I think sub-Saharan Africa might take a bit longer to recover than the rest of the world. What do we think for South Africa? Well, 3.3% for 2021, and then an average of 1.9% for the next 2 years. Now, I must tell you, 3.3% sounds okay-ish if you compare it to our, let's say, to the growth in the last 10 years in South Africa. But remember, we're growing off a much lower base. And it's going to take us a couple of years some people saying as much as 5 years, just to grow back to pre-pandemic levels. So yeah, I mean, 3.3% looks okay if you compare it to where we were historically, but we've got quite a bit of a way to go to get back to pre-pandemic levels. All right, so current market conditions, what's happening globally? One of the things we should see in 2021 is growth, like I just said, and a lot of that has to do with the fact that growth comes off a lower basis. So I don't know if it is to be cheered or not, but I mean, the COVID pandemic has been unprecedented in our lifetime. So the point is that that we've seen global growth returning quite quickly. So let's say within a year, where with the global financial crisis, it took a lot longer for markets and for GDPs to recover. So I think this time the world was maybe a little bit better prepared. Governments geared up their quantitative easing and all the things that they do to help the markets quite quickly. And we've seen what they call a V-shaped recovery. So the fall was quickly, but the recovery was also very quick. And that brings its own challenges. Government debt is increasing. Now, I need to just clarify this. This is not just in South Africa. I was at a conference of one of the big fund managers in South Africa probably a month ago. And they said, you know what, it is in fact so, and Yazeed spoke to that South African government debt is increasing, and worryingly so, from 60% to levels in the north of 80%. But the point is the whole world's government debt is increasing. We've actually got a global government debt crisis, if you want. Now, when these red flags start going up, red flags start going up when emerging markets, when their debt to GDP ratio, which is your main indicator of government debt, goes over 60% of GDP. And in developed markets, it becomes very dangerous. Red flags go up when the debt goes over 100% of your GDP. Now, debt to GDP ratio of over 100% means that your country owes as much money as is being produced by everyone living in that country in that year. I mean, that is a lot of money. Now, I sometimes get the question, why is there a difference for emerging markets versus developed markets? The answer is quite simple. Emerging markets have a lot higher borrowing costs than you have in your developed markets. So currently, South Africa is borrowing at around about 8.5%, whereas a country like America is borrowing at around about 1.5%. And a year ago, they were borrowing at rates sometimes less than 1%. So government debt is increasing, and there's some of the commentators who's writing to say this is unsustainable. There's academics called Reinhardt and Rogoff who wrote the whole book about this. He said this is unsustainable. We can't just continue increasing government debt. Somebody has got to pay this back. So yeah, I think one of the nice exceptions there is a country like New Zealand, who actually I think has got their debt nicely under control. Now, government is supporting the economies at this stage via what we call fiscal and monetary policies. So Yazeed spoke about that, a lot of fiscal help. We've seen on the weekend that the United States passed their $1.9 trillion now, and $1.9 trillion stimulus bill that they are going to pump back into the economy. So that is the fiscal help that countries are giving. So fiscal means we are giving it to our people out of the budget. And then also they are supporting it via monetary policies. And I saw there's a question that came in around monetary policies and fiscal support, quantitative easing. We will deal with that when we get to the question stage. But at this stage, governments are doing everything in their power. And I think this stimulus bill, I read something there that bill alone is more than twice what the whole of Europe has done so far. So, I mean, whilst it's good on the one side that you're stimulating the economy, you are increasing your debt on the other side. And there's, of course, a lot of debate in the market and amongst economists about whether that is the right thing to do or not. The point is governments are doing it, and they are also supporting the consumers with monetary policies. So that means they are keeping the interest rates low, and lower interest rates logically means we've got more money. If you're a bondholder like myself, you're paying off on a home. Lower interest rate means I have to pay back the lower amount there, so I've got a bit more money to spend. So that is the way the governments are helping. Vaccine rollouts are well underway. I mean, you guys are investment medical professional, so you'll know a lot more about me than that. But the point is this vaccine rollout is definitely contributing to what we call the feel-good factor that's going currently in the world, and we've seen that reflected, especially in equity markets. There is currently a slightly better political condition in the United States and in the UK than we had a year ago. I mean, under President Donald Trump, it was absolute chaos, especially in terms of global trade, him being on Twitter, being very impulsive. Now, that is not good for markets. Markets don't like that. Markets like certainty. So we've got slightly better political conditions there. And then we've also got the UK, who has finalized the Brexit deal, bearing a couple of details that still needs to be finalized, in my understanding. So that is still ongoing, but it seems like the markets think that the deal in general is not too bad for either side. And the fact that we've got slightly better political conditions should be beneficial to global trade with countries like ourselves and China, as I alluded to earlier. The travel and tourism sector, they are taking an absolute hiding, and so is anybody who's in property. They will take a lot longer to recover, and technology companies, your Netflix, your Facebook, your Apples, have all benefited Microsoft because they are helping us doing what we are doing tonight, to be online. And a lot of people are saying, but this thing will just grow. COVID has kind of tipped us over that place where online webinars, online meetings, all of those things will just grow. These companies will grow their revenue. Later on in this week, for example, I am going to a webinar where the full seminar, if you want, will be on software, and it will be from the comfort of your own home. But you've got like tables where you can sit. There's like places you can visit. They've developed a whole software where you can have like a whole seminar online. So I think all of that is revolutionized, and the tech companies is obviously benefiting from that. Now, very important, we can tell one another all of these things, and we can say, okay, the base was low, so there should be what we call some sort of mean reversion. So we should see an uptick in global growth. But, and this is a big but, the growth will be dependent on business and consumer confidence. What does that mean? Do the consumers have confidence in the economy? So the interesting stat is us as South Africans are not great savers. We don't save enough money. And I saw a stat that last year South Africans actually saved a lot more than they used to. And that just told us one thing. Told us that the consumer confidence is very low. So people, instead of taking that 100 rand that you've earned and going and spend it, they would rather save it. So that is good, but it means that people are not spending money. So consumer confidence, business confidence, especially in South Africa, very low at the moment. And then a topic that creates a lot of debate is at the moment we're seeing low inflation rates throughout the world, but that could increase. Now, I'm not going to give a lecture on inflation tonight, but I just want you to take note of this so that you also understand the debate that's going on, and why you will see these questions around inflation. So there's one school of thinking who says, well, if the inflation at the moment is low, but stimulus bills, and so it keeps coming through, and monetary policy stays what we call accommodative, so or very low interest rates, then we could see that as that money starts flowing through the market, that we could see a sudden increase in prices. Now, that could be good or bad, depending on who you ask. If you ask governments, maybe a bit higher inflation is good for them, because then they can increase interest rates, and it gives you a little bit of a buffer to play with again, and you don't have to print as much money. The other thing is it makes it a little bit easier for governments to pay back their debt, because the debt that they took out 10 years ago, let's say you issued a bond for $100,000, that inflation has now eaten away at that, and the government still only has to pay back the $100,000. But with inflation, it means that they technically, in terms of purchasing power, buying power, pay back less money, if that makes sense. So, bit high inflation may be good for governments, but not good for the consumer, and usually not great for the investment markets because it pulls some liquidity out of the cycle. So inflation is low, but it can increase. And when inflation increases, interest rates will probably go up, which could mean that markets will come down. Because there's often an inverse correlation between the two. So there's a lot of people who's quite scared of this, and there's a lot of people who's uncertain about what's going to happen. I mean, we can speculate a lot. There's very small people saying inflation will go up. There's very small people who say it won't happen. There's a lot of people talking about deflation and reflation, a lot of other inflation. The point is we don't know for certain what's going to happen with inflation, and I don't think that should be your main driving force around your investments. All right, what's happening with asset classes on a local level? The JSE came down a little bit today, but the JSE is sitting on or near all-time highs. Our government bonds are giving excellent yields. So our yields in government bonds are very, very good at the moment. So 8.5% is a real nice bond, especially for clients who's in living annuities, who is withdrawing an income from their investments. I mean, so to get 8.5% on that, without having to pay tax on that interest income portion within, remember, because it's a retirement product, it's really a nice yield. But we tell all of our clients who's got direct exposure to bonds, good yields, but it comes with risks. There's a reason why you're getting a good yield, and that is because the market is pricing in some of the inherent risks, one of which could be a default risk. So we often get questions from clients to say, will we go the route of Argentina, defaulted on their debt, to go to the IMF, defaulted on that again. So there's a lot of uncertainty around that. Okay? At the moment, well, the answer is we don't know. I think a lot of that will depend on what the political will is to implement a lot of the things that's been said in the budget, a lot of the solutions that's put forward. So we will have to see. Property, and when I'm talking about property here, I'm talking about listed property, not residential property. So typically your property that you can buy on the JSE, your iProp, your Redefine, your Growth Point, and some of the other property companies you always used to advertise during the rugby game. So those are the property companies listed on JSE. We did see a big sell-off with property companies, obviously. So their valuations at the moment is attractive. That means if you look at them historically, they are nice shares to buy maybe, but caution, there's a lot of uncertainty. And I've spoken to the guys at PPS Investments today again about this, and they confirmed that none of us can see a catalyst on the horizon that will all of a sudden ignite the property market again in South Africa. My personal opinion is that property companies will probably have to reinvent themselves and say, we're struggling in the office space market, and I can't see that subsiding anytime soon. We need to invest more in storage, in what you call hot desks, in remote working, in conference rooms, things like that. So I think the property market is very challenging at the moment. Like I say, valuations are attractive, but a lot of uncertainty. So just tread carefully. We do have them as part of our portfolios, but everybody is quite bullish about that at the moment. And then cash, interest rates very much sitting on 50-year lows in South Africa. So that is nice if you are a bond payer like myself who has to pay back their house, especially now that we've got a baby at home. I'm telling you that extra money comes in very handy, but it's not nice if you are retired and you want to sit on cash and you want to get an income from that. So we feel that your cash has to be invested somewhere, at least as part of your portfolio. You can sit on cash, but just know that it also comes with its own risk. What's happening, I'll cover this very quickly, not in as much detail as I did for ours. So where we are at the moment in the developed markets, so that's your first world countries, America, all those, equity very fully valued at the moment, especially in the tech sector. So we have seen something very interesting happening in America. In South Africa, on the JSE, we've always spoken about something called the concentration risk, where we said a share like Naspers and BHP Billiton, and so they make up too big a part of our index. So if you buy the index, you're buying more than half of the index is like 5 companies. So, I mean, there's a big concentration risk. For very long, In a country like the United States, we did not see that. I mean, you've got the S&P 500, the biggest weighting in there was like 3%, which was Apple. And now all of a sudden we've seen that the tech sector has started to pull away from the rest of the market. So very, very high valuations in the tech sector, a lot of future earnings being priced in there. So the market is basically thinking, you know what, these companies are going to continue growing. And we've already seen a bit of a sell-off in that sector last week. So the NASDAQ has wiped out by last week Friday all of the gains that it has made, or last week Thursday, all of the gains it's made in the year so far. So once we've seen bonds increase, the yields increase in the US, we've seen a bit of a sell-off there. So I think it might be late in the cycle. I think the valuation might be high, but I mean, in a well-diversified portfolio, you will still have exposure to that. But I won't be surprised if a lot of the fund managers has just started to jump back and taken some profits from that already. Developed markets, bonds, yields very low. Like I said, America a year ago, you got only 0.75% over the term for the bonds. So that has doubled now, and we've seen bond yields increase last week already. So the bond yields, as of today, I've actually checked it in America, the 10-year bond is 1.56%, like I said, versus 0.75 a year ago. So bond yields definitely on the uptick. Now, what happens when that happens is people are saying, okay, I can get they call it a risk-free investment, even there's no such thing, but in theory, they say, I can get 1.56% risk-free in America. And I'm not sure if I'm going to get that in the market going forward. All the markets could dip by 20%. So investors, when interest rates go up, tend to withdraw money out of equity markets. So it's going to be interesting to see how that dynamic plays out. Property, same issues as in South Africa, cash even lower than we have and at extremely unattractive rates. In fact, there's a phenomenon in a lot of the first world where you're paying the bank to keep your money. So you get negative interest rates, which is quite bizarre if you think about it. Well, emerging markets are also high, but not as overvalued as their developed counterparts. Very interestingly, though, developed markets has grown in the last year on year, by 29.5%, where emerging markets actually grown by 35% in dollar terms year on year. So emerging markets has had a great run, especially in dollar terms, because of the dollar weakening a little bit, but they are not as overvalued as their developed counterparts. So still a little bit of opportunities there, but also starting to show some risk. And we all know that there's inherent risks part of emerging markets. And a big driver of that growth also came out of China, which makes up about 30% of the MSCI emerging market index. All right, government bonds giving decent yields, much better than in your developed markets. Property, once again, might be opportunity, but there's risk. And cash interest rates remain low, even though it's not as low as with the first world. So another question is we've now said a lot of things about what happened in the budget, about what is happening in South Africa. We can have a whole evening's lecture and debate if you want about the political and economical situation. But the question we get from clients is to say, what is it that we should do now with our money? Now, the best advice I can give you is to stay calm and assess any situation before you make knee-jerk reactions. Now, in every lecture that I ever do, on every webinar that I ever do, any presentation, I tell people, if you forget everything I say, and you remember just one thing, you can take one thing with you. I want to ask you tonight that it be this: stay calm and assess. I will give you a great example. If you were in a coma for the last year, you went into a coma, where are we today? On the 8th of March, 2020. And you woke up today, exactly a year later, and you opened up your investment statement and saw what was happening in your investment. You would have been really happy because markets has grown nicely. You would not have known that we are in the middle of a world pandemic. Yet we saw, and the stats prove this, that a lot of people withdrew money out of the markets when the markets were plummeting. So our clients find us and say, what do we do now? And our advice to them is often nothing, just sit on your hands. And if you're invested in a good multi-managed fund, then you must trust your fund manager to make the right asset allocations, to get out of market at the right times, and to get back in the market at the right time. For you as an individual to do that is very, very difficult. Even some of the best traders in the world can't do that. So what do I do with my investments? The first thing that I want to urge you is just to stay calm and make a proper assessment of what's going on in the world before you make any knee-jerk reactions. That speaks to my second point, which says have a proper financial plan. When you have a proper financial plan, it should make provision for you, for instance, to have what I call a buffer account or emergency account with 3 to 6 months worth of savings expenses in there, so that you can weather a storm when you get retrenched or something goes wrong. I know of a dentist actually who became disabled after injuring his back. So in that process where you are still claiming, still trying to sort out your life, it's very helpful to have an emergency plan in place. You don't want to go to the market and withdraw your money now because you need it, the money that you saved from your investment. Now, if you've got a proper financial plan, your plan should also speak to what to do when things like this pandemic happens. And if you've got a proper long-term financial plan, things like market corrections, dips, recessions, this pandemic, I'm sure in our lifetime we could see another pandemic more or less similar to this. Point is, if you've got a proper financial plan, that will put you on track, and that will help you to stay calm, because now you know what is the plan, what is it that you're going to do, and you will make sure that you've got enough savings. Now, this third point is almost as important as the first two. And I know if you say everything is important later on, nothing is important, but being diversified is probably the most important and crucial thing that you can do when markets are volatile and when there's as much political and economic certainty as there is currently in the world. Now, what does diversification mean? And we'll get back to my previous slide just now. Diversification means diversify firstly within asset classes. So within asset classes means if you've got, you know a little bit about what's going on in the markets and in the world, you've got a share portfolio, make sure that that share portfolio is well diversified over different sectors. You don't want to diversify by buying 5 different banks within your portfolio, for instance. You want to make sure that you buy in the financial sector, in the healthcare sector, in the tourism sector, whatever. And if you don't know how to do that, rather get professional advice. But make sure that you are diversified well within an asset class. Okay, so make sure that you can say, yeah, I've got 10 different shares. But if they're all in mining companies, then you're not well diversified. Make sure that you apply that principle. Then make sure you are diversified between asset classes. So I remember when I started in this industry 10 years ago, you could just prompt any client pretty much in 2011, 2012 in an equity fund, and they would have seen double-digit returns year on, year out. It was as easy as that. Since about 2015, 2016, 2017, there's been a change in the thinking of how you should invest. And the change in thinking says now, and a lot of the investors agree about this, to say you should be diversified between asset classes because equity markets has also got their own risk. So if you're a client that is not as comfortable with that market volatility, make sure you are diversified between asset classes. What does that mean? I've got some money in cash, I've got some money in bonds, I've got money in property, I've got money in equity, and I've got those same asset classes offshore. And I'll speak to that just now. Make sure you are diversified between asset classes and make sure that you've got somebody who can actively manage that for you. What should the allocation be? How much cash, how much equity, how much bonds should you have? Well, that depends on your risk profile and where you are currently in your life. So somebody who's younger will typically have more equity. Somebody who's older and withdrawing income might have more bonds, for instance, at the moment in their portfolios. So make sure you're well diversified between asset classes as well. I think personally the days of just plumping everything in equity, I think those days are gone, but that's just my view. Make sure that if you are using different unit trust funds, that you diversify between different management styles. I often get the clients tell me, now I'm well diversified, I've got money, and then they name 2 or 3 of the biggest asset managers in South Africa. But they don't know that a lot of them manage money in the same way. Most of the big massive asset managers in South Africa are what we call value managers. So they go and look for prices that for shares or other assets that is mispriced, and they buy them where they see value. But you need to also have guys who's got a style of looking at growth. Asset managers who's looking at cyclical investing. Asset managers who looks at macroeconomic trends and then invest what they call top down instead of what the other guys do, what we call bottom up. So please make sure that if you've got money in different unit trusts with different companies, that they have different styles, because otherwise you're not really all that well diversified. Now, the big thing, and once again, I can do a whole evening lecture about this, which we won't do, between local and offshore. Make sure that you are diversified offshore as well as local. Within your retirement funds, you can go as high as 30% offshore and then another 5% in Africa. But just remember one thing. South Africa makes up only about 1% of global markets. So if you're investing only in South Africa, you're missing out on a big world out there, like, for instance, the biotech industry in America that's booming, and where you can make a lot of money. So just realize that there's a big world out there. We make up 1% of that. Make sure that you've got assets offshore. We often get the question as well from clients, how much money should we take offshore? Well, that depends. It could be anything. The answer, in my experience, is between 25 and 75%, depending on your age, on the income you're drawing, on whether you would like to leave something to your children, on whether you will outlive your assets or not, on whether you want to remain living in South Africa or retire elsewhere. There's a lot of things that you must take in consideration. We are not there as PPS to say, oh, South Africa has got no hope, take all of your money offshore. But we are saying, if you're investing, make sure that you've got a chunk of that offshore, you've diversified offshore, and then all the same principles also happens offshore. So if you're offshore, also make sure that you've got different sectors in different countries. Now, the reason I put in here, understand the value of multi-managed funds, like BPS has, for instance, and many other companies have, is when you are investing in a multi-managed fund, your fund manager will decide on your behalf who is the other investment companies that we need to use. And your fund manager will make sure you are well diversified. They make sure that you are diversified across styles. They make sure that specialists invest. So if, for instance, you get specialists in interest rate investing, they will make sure that they will manage that part of the portfolio. Your multi-managed funds will do the asset allocation on your behalf and say, this is how much money should be in bonds now, in equity, whatever. They will make sure that you are well diversified across asset classes and management styles. So if you are new to the world of investing, you want to invest, then consider investing in multi-managed funds, because a lot of what I've spoken about now gets done for you by the main fund manager at that level. So that will benefit you. Right, so what we said is we said stay calm, have a proper plan, make sure you are diversified, understand the value of advice. Now, I can tell you, apart from the empirical studies that's been done, there's value in getting advice from an advisor. And I want to bring this back to point number one. The value of advice for me lies in that. I always tell clients, you pay me for my expertise, you pay me to know what's going on in the world, you pay me for a lot of things. But one of the most important things that you pay me for is for my objectivity. So, for instance, just to put that into context for you, I manage nobody in my family's finances for them. I don't give them advice on the investments. For the simple reason is I am too close to that fire. I can't stand away and objectively assess the situation. There's this concept called loss aversion. So if you are very bored, go and Google that. It's a concept they use in behavioral finance, where they say when you have an investment and you made 10%, the amount of joy that you experience is not the same as when you've lost 10%. I've seen this many times, that we give clients a financial plan in the hand and say, this is it, go and implement it. And they say, yeah, no, I understand the markets go up and down, and I understand that there's volatility sometimes and so. And then the moment that disaster strikes like last year, those same clients come back and say, what do we do now? Because they panic. Because, and I've heard these words so many times, but they say, this time is different. This time the markets won't recover. This is a prolonged thing. I mean, the value of advice is an advisor who can tell you, listen, just sit in your hands. Or say, yep, now here is a problem. We need to make some changes to your portfolio. Hopefully your plan is not so sensitive to world events that you need to change it at every turn, but the value of that advice is for somebody objective to tell you, just sit on your hands. So if you do not have an advisor, consider getting an advisor so that you've got somebody else who can manage this for you and who can tell you, keep calm. And if they tell you keep calm, then please do that. Or who can tell you, listen, no, there is a problem. We need to make a change. My second last point is what something we call rand cost. I call it rand cost averaging. The concept actually originated in the United States, and it's a principle called dollar cost averaging. Now, I'm not going to go into the technical aspects of that tonight, but I'm just going to try and share with you what that means. So let's say you've got an offshore investment and you've got $8,000 in that investment. Let's say the market has done what this graph is that I have here on the screen. If you invested that money right at the beginning, markets would have gone up and down, and at the end of the day, here at the end, you would have still had the exact same amount of money that you had in the beginning, obviously excluding dividends, and you would have had zero return on your lump sum investment. If you use what we call rand cost averaging or dollar cost averaging's principle says make sure that you put away the same amount of money every month to the same asset. So let's say you're buying units in a fund, average it over a period of time. And hopefully for as long as you can, every month for the rest of your life, if you like. Because what happens now is the money that you've invested here in the beginning, right? That will grow as the markets go up, and then you're happy. But people who put away monthly money also buys the market dips. And the principle is that if you put 1,000 Rand a month into an investment, when the market has come down and there was a dip, you're buying more equity, more units for that same Rand amount. So 1,000 Rand buys you more units. And empirically, it's been proven that in most cases, over a long period of time, that will really benefit you. The only time it won't benefit you is if you, for instance, invested your lump sum here at $7.5, and that has grown quite nicely. But it is so difficult in time the markets if you can't. So what do we tell clients to do when markets are this volatile? I say to them, make use of the volatility. If the markets go up, you're glad because your capital is grown. The markets come down, but you know I'm going to pump in money every month. Then you buy assets at a lower price. And your average cost, hence the name dollar cost averaging or rand cost averaging, per unit that you buy, then will come down. In the long term, you will benefit from that. So that is one nice way that you can get past this market volatility. Right, so the last one I put in there to say, if you're not saving every month, the one thing I can tell you is please be frugal. Make sure that you do a proper budget. Make sure that you are not spending unnecessary money. And most importantly, make sure that you are not withdrawing unnecessary money out of your savings, out of your bond, out of your investments, whether that be in equity or multi-asset funds, or whatever you might be investing in. So what is it that you should do? Let's just recap. First of all, just stay calm. Don't knee-jerk. If you're going to knee-jerk every time the market sells off and try and buy back your assets every time the market goes up, then you're a classic, one of the 85% people that they found in behavioral finance who is driven by greed and fear, who sells when assets are falling and who buys when it's climbing. Okay, so just stay calm. That is my one thing I want you to take from tonight. Second thing is have a proper financial plan so that you know, even if markets go up and down, if I put away a certain amount of money every month, I know where I will end up. That will help you not panic when the markets are so volatile as they are at the moment. Third thing is ensure you are well diversified. This is critically important. Get your advisor who can help you do this. But if you know how to do it on your own, just make sure that you are well diversified. I think the number one piece of advice I give clients at the moment, and that I do with my own portfolio, is I make sure that I'm well diversified, local, offshore, and that I've got money in different asset classes so that you can benefit from market movements as they have. Best is, do you have a manager that can make those decisions on your behalf? Because the reality is you are working with patients the whole day. You're not going to sit in front of your computer looking at the markets. Even me who's well versed in that, don't do that. I trust most of my money. I manage a small portfolio, a bit of that on my own. But most of it, I trust somebody who can look at that day in, day out, make the right call. So therefore, multi-asset and multi-managed funds, very good to have at the moment. Make sure that you make use of markets that go up and down by doing what we call rand cost, or if you want dollar cost averaging, ensure you save money every month. Then if you are in that stage where you're retired, for instance, or you can't put away money for whatever the reason may be, I've got a couple of clients like that. For instance, clients who's retired, who say, I can't put away more money. I mean, I'm done. I'm withdrawing an income. To them, I say, for now, make sure it's as low as you can possibly live on. Be frugal. That's going to be your friend. All right, Faisal, so thank you so much. That is everything from my side. I think the real value of sessions like this is in the questions. So I think let's jump into that and take some questions, and we're going to try and give you some sensible answers on that. Thank you so much.
So, Wynand, thank you so much for that. I mean, it was awesome as usual. We've learned a lot. It started off a bit on the negative side, but I think you've covered up at the end by giving us some hope. When it comes to the part of being frugal, I think as dentists, we've taken the brunt of COVID, and it's hit us hard ourselves. So I think by default, we have to be frugal in any case.
Yeah.
But with that being said, your advice of the dollar averaging makes a lot of sense. The whole point of diversification makes a lot of sense. And I think if we just stick to our knittings and just be consistent, we should be okay in the medium to longer term. I guess investing is a long-term game, and we've got to play the long game when it comes to these type of things.
Exactly. It's
Yeah,
exactly that. And I think, if you've got a proper plan of how I want to invest, and you just stick to that, you will be better off in the long run.
yeah. So as I mentioned before, we've got a huge turnout tonight, and the PPS webinars are usually very, very well attended. So definitely the profession is very mindful of the investments and the income. And I know there's some amazing questions. So let's get into the questions, if you don't mind. Okay, so the first question has to do with quantitative easing. I think not so long ago, Ace Magashula made a comment about quantitative easing. I'm not going to go into the whole question, but the idea was that South Africa should maybe consider quantitative easing. I've also raised this on some accounts because what I don't understand is how do the developed markets get away with it? And when it comes to us who are emerging markets, the threat is that it may lead to hyperinflation and all of those type of things, right? But maybe we guys don't understand it as enough. But what we do know is the US gets away with it, Europe gets away with it, and we are the oaks that our debt levels are always rising. So maybe you could shed some light on that and tell us whether Ace has a point or not.
I'd rather not comment on it. You just stick to the economic part of that. So I think it's an excellent question. So it basically deals with what is called qualitative easing, which I don't know what that is. We talk about quantitative easing. Now, quantitative easing is in a certain effect a country's printing money. So to use America again as an example, the Federal Reserve will say we will buy bonds. So from the government, which means they put it on their balance sheet, and there's more money all of a sudden in the system. Okay, so quantitative easing, literally in its purest form, means you are printing money. Now the question is these countries have got multiples of the debt levels that we have, which is not quite true. So they are more. It's not. I won't say it's necessarily multiples, except in some cases here and there. But the thing is if you are the country in the world like America that is printing the world's reserve currency, that is being traded. And the last that I saw was that the US dollar is traded at one side of the transaction in more than 60% of forex transactions worldwide every day. Then it becomes a lot easier for you to print money. The point is when it comes to money, basic supply and demand also comes into play. So the more the money there is in the system, the weaker your currency will be. And if you want to take an extreme example, you've got a country like Zimbabwe who just printed money, and I mean, there's so much money in the system, so you have this hyperinflation. The same thing, in a sense, also happens in America, but they've got the world's reserve currency. So, I mean, even a weaker dollar doesn't lead to massive inflation for them. Okay, so because the thing is remember, South Africa is an importing country. So if we print more money, our currency weakens and we import inflation alongside with that. And then all of a sudden our inflation goes up a lot. So the other thing that you must also remember is this quantitative easing is a tool that is often being used when you don't have any monetary space to maneuver in anymore. So when your interest rate has just about reached rock bottom, and that is what I think the Reserve Bank of the governor of the Reserve Bank of South Africa has also said. He said, you know what, we still have space to maneuver. And he admitted that there's more and more people asking this question and saying we should maybe consider doing that. My personal view is that it will not be good for us. We will create hyperinflation, which you don't have in the first world because they don't import as much inflation because their currency don't devalue as quickly then if you're printing money, if that makes sense. Now, what happens is he also said we still got some monetary room to maneuver, so we can still lower interest rates a bit before we actually start considering that. And I think they're just creating themselves a little bit of a buffer there. But in my experience, when you start printing money, and we've seen this in the first world, it's very difficult to put that genie back in the bottle. So I think that's one of the other risks. So one, you've got an inflation risk. Because remember, there's already the interest rate differentials and all those things that create inflation in South Africa. Now you're printing money. So you're making the disconnect between us and the first world countries much bigger, where the first world don't necessarily have that problem because they've got reserve currencies and they also they don't import as much inflation as we do. I hope that makes sense.
Yeah. Okay, so the next question has to do with obviously the national debt that's owing, and it's what Yazeed alluded to, which is the 11 zeros. The question basically asks, will our national budgets eventually be decided in Brussels or Beijing because of our monetary debt to them? Will they force austerity measures on us and in the process take over our pension funds because of the escalating national debt? So I think what the member is concerned about is, will we lose our pensions, or is there a risk of us losing our pensions if we as a country default on our debt?
Yeah, so there's a lot of answers to this. I try and keep it as simple as I possibly can. So the first thing is can we become beholden to them? I mean, if we go to the IMF, which will be, it will be politically very unpopular to do that. Because in a certain sense, that will be an admission of the government to say, we couldn't manage these finances on our own. We now need what we call first world capital now, and it's perceived as that. So now we need that. And so politically, it's not a very popular thing to do. We did go to the IMF for a loan in the COVID time to help with some of the COVID relief. So, but the restrictions on that was not as stringent as when the IMF gives you a proper bailout and a loan. So the short answer to that is it might be. I mean, the one city that you don't have in it is a very beautiful city, by the way, is Washington D.C. So if we get a bailout from the IMF, then we will be. What happens then is they dictate what should happen in your budget because they're saying we can't lend you money that other countries are effectively giving you, and then you can just do with that whatever you want. So they then will say we want you to work within a prudent fiscal framework. So it's not so much that they will then control it, but they will have to okay next to your budget and say, listen, okay, but you can't spend so much. So it will reel in the spending. Whether that's the worst thing or not that can happen to South Africa is also a debate. There's some economists that says actually that could be good for South Africa. We get some of that capital in, we get our house in order and build from that. Because remember, that was always the idea of the IMF, to say if countries like us can default potentially on our debt, to give money to get a house in order to grow from there. And I do think Africa has got the growth potential that if we just get our house in order now and we can piggyback off of that, it could be beneficial for us. Whether we will do that or not, that remains to be seen. We might go to China. Some of the economists think there's not somebody else who can really got enough money to bail us out. I don't have all of those details, so I don't want to speculate on that. So the short answer is it could happen. Will that happen? Will that cause austerity in our pensions? Well, the IMF can't come in and take your pension. I mean, that will go against everything in the constitution, just about in every country in the world. I think one of the big fears around our pensions phase is that we keep hearing this thing about prescribed assets, where the government of South Africa can come in and say, listen, we are going to force you to invest in certain sectors. So it seems like the dust has settled on that a little bit. But I mean, is that a risk for our pensions? I suppose that remains a political risk. It's not something we are overly concerned with at the moment. And there's not been a lot of talk about this lately. And remember, you've already got a certain sense of limitations in your pension with Regulation 28. So government could come and say, you know, we're opening up the construction sector, for instance, is what's in the news a lot lately, and you can invest in infrastructure projects in South Africa. There's a lot of people who are scared that the government will force us to do that, but there's nothing that I have seen actually that we are close to that being done. So I think when we go to the IMF, you know, I don't think they can come in and take our pensions, but there's a lot of uncertainty in terms of what the government can do with this massive pension pot that's sitting there. Will they do that before they go to the IMF? Well, I think the jury is still out on that.
Thank you. I think the next question is for Yazeed. It says, has Mr. Davids any idea of what the government regard as wealth in terms of the wealth tax?
Yeah, thanks for that.
I think should we as dentists be worried, hey?
Yeah, look, there's a few years ago, the Davids tax committees made recommendations to the South African government in terms of what the proposed wealth tax looks like. Right, so there's a draft that's floating around in terms of what the legal framework is. We as tax professionals, we don't have sight of that proposed legal framework and how it actually works. So to answer the question, no, we know it exists. We just don't know what the framework of this new wealth tax is.
So we'll have to basically wait and see, hey?
Absolutely.
Good stuff. Okay, this is a question that maybe the two of you can answer. Do you think Bitcoin a better investment than gold and silver? Today, the first publicly traded Chinese company announced its purchase into Bitcoin. Bitcoin now stands at $51,000 presently. Elon Musk invested in Bitcoin substantially 2 weeks ago. The big players are all following this route. What do you guys think?
Yeah, so Bitcoin is a question that we get in just about every presentation and webinar that we do. There's a lot of differing opinions on Bitcoin. So I'll give you a high level thing. I think one of the difficulties in Bitcoin is that a lot of people don't fully understand how it works. They understand the blockchain technology. They understand that it's getting verified by independent computers. But the difficulty a lot of the asset managers and investors have with this Bitcoin is twofold. One, it's not something physical that you can see where a company has got annual results. You know, gold is something that is physically there. That's the first thing. The second thing is Bitcoin is highly speculative. So I mean, the volatility in Bitcoin is massive. Now, what is difficult in Bitcoin at the moment to classify as an asset class is you can't do a discounted cash flow on that you value and to say this is how much Bitcoin should be worth from a market perspective. The problem with Bitcoin is it is only worth what the next person is willing to pay for that. And we've seen a lot of hype. We've seen a lot of people actually investing in Bitcoin, buying up Bitcoins. And then there was sharp sell-off in Bitcoins as well. my difficulty phase at the moment with Bitcoin is if we only had Bitcoin, that for me would be something that I would say, okay, we've got this digital currency. I think we should take it serious. Let's investigate that and maybe invest a part of your portfolios in that. All of a sudden, there's been this explosion in virtual currencies all over the world. My question is which one is going to be the next currency if you want for those people who think that Bitcoin will become the next currency? So that is one of the other difficulties we have with Bitcoin. And also, I mean, will it be regulated? Will it be not? You already pay capital gains tax on proceeds that you get from Bitcoin. So, I mean, is Bitcoin going to be, is it an asset class? Well, in the traditional sense of the word asset class and things I've discussed now, it's not. It's a speculative investment. I always tell clients that if you want to speculate and you want to go into that, make sure it's not bread and butter money. It's money that you are happy to lose should something go wrong. So there's a lot of things that can be said about Bitcoin. I myself am still a little bit skeptical about that because of the fact that we've seen this explosion. It's not regulated, and I don't know what somebody's going to pay for that tomorrow. I mean, people who bought it many years ago have smiled all the way. There's no way that you can argue that away. But and I wouldn't be surprised to see digital currencies coming into your traditional asset portfolios at some stage. My personal view is that I would much rather have a fund manager who can take some sort of macroeconomic view on that and understand a little bit about how it's working to buy that on my behalf instead of me going to buy it on my own. So yeah, I mean, it's like there's a lot of things that's increased in value that much, and it remains speculative, all of that. So is it a better investment in silver and gold? I think it's something completely different. The thing is silver and gold has been along for many years. Bitcoin has got a very short track record, and even the growth has been phenomenal. There's a lot of things that can just bring down the price as quickly as possible, as quickly as it went up again. So no, that's kind of where I am on Bitcoin.
I concur with you. I had a debate with my brother recently, and he was like all excited about Bitcoin. So I showed him a picture of gold, what $1 billion worth of gold looks like, and what $1 billion worth of Bitcoin looks like. And the Bitcoin is basically a barcode.
Yeah.
When you put the two next to each other, you really think about it and you wonder, wow, is this for real? The other thing I don't understand about Bitcoin is people take hard-earned fiat money and they buy Bitcoin. So there's someone on the other hand selling Bitcoin to take the fiat money. So for me, that just doesn't make sense. I mean, you're putting your hard-earned money to something that's not tangible. You can't touch it. You can't see it. It's basically a barcode there in cyberspace. So I think time will tell where that's going to go.
Yeah.
Yazeed,
I mean, the person who asked the question correctly also says that somebody like Elon Musk has invested in that. The flip side of that is that you can just as easily disinvest from that. There were companies at some stage who said we're accepting Bitcoin and that reversed on that again. So I think the question is, I think the verdict is still out. The fact that there can be only limited Bitcoins in the world, what will happen? And we don't yet know what will happen once all the Bitcoins have been mined. So I mean, what will happen to the price then? What will happen with all the flurry of new? That's my biggest concern. To be honest with you, is one that you can't value it on discounted value method, and the second thing is what about all of the other cryptocurrencies that's popping all over the place?
Litecoin and Dogecoin and
yeah, and I mean, there's literally thousands now. So, I mean, what if that dilutes the value overall? I don't know. I won't say there's no space for that in the investment world. My personal view is just I would feel better if an investment professional sees value in there. I trust them that they will invest in that.
Yes, there is a question about VAT. I mean, the 1 million rand threshold has been there for like a long time, right? Yeah. Is there any chance of them extending that? Because $1 million to get to in turnover, I mean, it's not hard nowadays, right? But it's burdensome on small businesses.
Absolutely.
So, I mean, there's two things which I see the finance minister doesn't ever increase. It's the debt tax, the 3.5 million threshold on estate tax, and the 1 million on VAT. That doesn't seem to ever increase in line with inflation and growth or whatever.
Yeah. So Faisal, just to take a step backwards, remember this isn't a requirement. This is a requirement in order to register as a VAT vendor, right? So like the, as per the audience member, the requirement unfortunately hasn't changed for quite a number of years, right?
Yeah.
Million rand, unfortunately, that is what the legal framework says. If your taxable sales are $1 million and above, then you ought to register as VAT vendor. And just earlier on in my presentation, remember that we're sitting with a big tax deficit. One of the components of those collection is a VAT component as well. And if I look at the numbers, it's 27.1% from that tax collection is going to come from VAT. Yeah. So in terms of the requirement, I don't see the government increasing the requirement for registering for VAT in the next foreseeable future. But then also depends, also a lot of factors once and variables that once need to take in consideration. How is your entity registered for tax purposes? So those are all things that one needs to consider. But yeah, especially from the VAT side of things, I don't see that changing. The compulsory VAT requirement is $1 million, and that's been so for a very long time now.
Good stuff, guys. Thank you very much. That brings us to the end of our Q&A session. We got 1 minute to round up. If any one of you wants to kind of give us some quick snippets as we end off, that'll be awesome. Wynand?
Yeah, thank you, Faisal, once again for having us from a PPS side. We are so privileged to be here, and I hope that it was valuable for you. I know that sitting in a webinar after a long day, really after you've worked hard, it takes a lot. So I'm very thankful for each of the 400 plus participants that we've had. Once again, I mean, if I look at the questions, and so all of that can come back to one answer, and that is to make sure you're well diversified. There's a question there if you want, I can answer offline. But the thing is what is going to happen if China dumps all the debt? Are we hyperinflation or not? Well, the thing is there's some scenario planners who say if that thing comes unhinged, then buckle up. There's going to be a lot of knock-on effects for the world. The point is we don't know how it's going to play out. Make sure you're well diversified. That is the best advice I can give you tonight.
Thank you so much for that. Yazeed, any final comments?
Yeah, certainly from a tax side of things, Faisal, I think the next 6 months will be critical in terms of consolidating, in terms of whatever expenditure we incur or foresee in our businesses. Remember, it's only a measurement in terms of what the budget has actually stated in there. The next 6 months will be crucial in terms of what the recovery is all about, because there is a midterm budget policy review that's coming out in October. So that is personally my view. Next 6 months is crucial. We'll take a measurement again in October to see exactly have the government followed through in terms of the spend and what it was spent on with, and what the market recovery is in terms of our economy off the back end of the pandemic. Yeah.
Thank you. Guys, thank you for indulging us tonight. Thanks to PPS always bringing the experts online to educate the dentist. Colleagues, please remember to fill out the evaluation form at the end of this webinar. Thank you so much, Marilis, for arranging everything. Guys, I mean, we've learned a lot. I've learned a lot. And I'm sure the colleagues out there have learned a lot. I mean, if anything, we just got to focus on the snippets that Wynand put at the end. No knee-jerk reaction. Think about it, diversify, and just stay calm. Just stay calm. So Wynand, thank you for that. Yazeed, thank you for your input. Guys, I wish you a wonderful evening. Thank you for tuning in. And we'll see you. Remember the webinars for the rest of the month, the one tomorrow with the Peat Society. Hope to see you guys soon. Thank you very much and enjoy your evening.
Thank you.
Thank you.
Right.
Thank you, gentlemen.